Well, we appreciate everybody that's come on today onto the webinar. It's a historic time in the grain markets, and we felt that that we wanted to provide what information we could first, so folks could understand or have a perspective on the volatility and price levels that we have, and really kind of gain an opinion as to their sustainability. So we want to do that, and in approaching that, we wanted, of course, we'll have a U.S. focus, but so much of the driving factors that are impacting the grain markets are international in scope. So I really appreciate my colleagues. There's a wise saying that wisdom comes in with a multitude of counselors. So I've got a multitude, at least a couple really good counselors. Guy Allen's here with his senior economist with the International Grains Program at KSU. He'll be commenting on a number of the international grain market issues that come up. Mark Wood, also his colleague of mine, he's at the Kansas Farm Management Association. His office is in Northwest Kansas. Mark's really strong on cost of production issues, and I wanted to bring Mark on to give us a perspective on the profitability of some of these forward contract opportunities that we're seeing right now in the markets. So I wanted to give an overview and trying to describe why are we seeing this volatility? Well, a key factor causing grain market prices to be high and volatile. Here we go. Escape thing here. Here we go. It's a scarcity, and not just a little bit of scarcity. It's the threat of scarce U.S. and world grain oilseed supply demand balances to food supplies. So the scarcity of grains and oilseeds as they're used to produce food across the world in various countries, and basically buyers are fearful of getting caught short. And fear when you get in a normal situation, well, there's arbitrage and bidding back and forth on who might buy what, and there's the idea that if I don't buy, so often when we're not urgent in the markets, there's the idea that if we don't buy grain today, well, I can hold off and it'll probably be there in a week or so. Well, that's not the case now at all. We're in a fearful, scarce market. U.S. world foods, and it's a food supply issue. These grains are going into livestock. It's also an energy supply issue. So U.S. and world food supplies are threatened enough to cause an extreme urgency across grain and oilseed markets for buyers to want to purchase crop supplies to avoid being caught short. And what's interesting to me, both a U.S. Western Corn Belt perspective and also an international perspective, is that there are direct effects and there are cross-market effects. What's happening in feed grains is affecting the wheat, and what's happening in soybeans is affecting corn planting. So we've ran up high enough in these markets that we're having major cross-market effects, both in the domestic market and international wheat feeding. We'll talk about that, all in play now. I do want to talk a little bit first before we look at the international things to some of the fears that are driving what we're seeing here in the continental United States. And of course, the main thing that has people's attention, I think, has to do with the dry conditions in North Dakota, going over to eastern Montana, down South Dakota, and up into Canada. Alberta, very, very dry in terms of wheat production prospects. The area that last summer in Iowa was the big issue until the Derecho storm came through in the southern and eastern part of the state, were the dry conditions in north central Iowa. And that is on its way to going forth again. So I'm certainly aware of what's happening in North Dakota, but if you start drying out the significant part of Iowa, and they start losing corn and soybean production, we have a major issue here in the United States. You've got dry conditions in the Eastern Corn Belt, and again, Ohio, parts of Michigan and Indiana, et cetera. Nothing to fall asleep on. We've got dry conditions creeping back in after a great rain, or some great rainfall, creeping back into the Oklahoma Panhandle, the Texas Panhandle, Southwest Kansas, et cetera. So a number of things coming into play, and something we shouldn't underestimate with with the strength of white wheat exports this year out to Asia is what's happening in the Pacific Northwest to white wheat production there. So Guy, if you want to talk about that later, we can. Now, Guy, I want to kind of tee this up for you as you look at this kind of a world map of major countries in the world. With the more red and black, you see you got dry conditions. There's a lot of dry conditions. It's pretty important areas of the nation.
So look,
of the
we'll
world.
take a quick run around, and I guess initially we'll just go north of the border in Canada, and the dry situation in North Dakota is reflected in the major growing areas in southern Canada there as well, which is impacting that situation much the same as North Dakota, as they're trying to get the spring wheat and the spring crops in there, and it's could have a significant impact. So we're keeping a pretty close eye on that. The next place I'd like to go is to South America, particularly to the Brazilian situation. And I think what we're looking at most immediately is the impact it's having on the second corn crop, the safrinha corn crop. Just late last week, they dropped the estimates, the trade estimates, to about 103 million metric tons, which was down about 5.8 million metric tons from previous. There's some talk that the USDA could actually drop that number below 100 before it's over. That's key because we're going to need that corn crop to get us through to the Northern Hemisphere harvest situation. And if that continues to drop significantly, it's going to put us in a precarious situation with corn alongside the soybean situation.
The possibility to the degree that crop is short, there's a window between the end of when that crop is frontal for exports and when the United States crop is coming into play. And man, you've got the potential for a whole lot of tight, inelastic demand happening late summer.
Yeah, and look, it also has an impact on soybeans. I think the soybean situation has been solved for the time being. Just to comment on as we approach the logistical shift from South America back to North America, as we get to September, it's going to be a question of how quickly does Brazil sell out of soybeans? So how quick does that need to switch back north? And then how early is the crop, the soybean harvest? And we had that logistical situation when we switched to the south, but that I think will be the next opportunity for the run on soybeans.
If I can just add, latest USDA reports stating that dryness dominating Argentina, dryness dominating southern Brazil. So yeah. Big issues
there. So moving on to the next area, I think we've got Mexico. We don't want to forget the Western Mexico situation. Look, it's usually dry down there, but it's exceptionally dry. They're historically have been our largest buyers, both wheat and corn, and that'll definitely drive their volume of imports going forward. So it's a concern.
And again, those dry conditions. Bill Tierney, former colleague of ours here at KSU, came out this morning, was talking about the dryness in Alberta, and so big thing. Do you want to talk about Asia?
Yeah. Next, we'll move to Asia, and I sort of want to focus on China's situation. China is the second largest corn producer, producing about 260 million metric tons annually, and they're the largest wheat producer. That north area, particularly where we've got the dry area, is more Inner Mongolia area. That's northern China. That's your major big corn producing area. And that dry weather, I think, is increasing concern. Their season is similar to ours, and I can't help but think that that dry weather is helping to prompt some of these new crop corn purchases that we're seeing already.
You were the one ringing the bell, Guy, at least that I heard, talking about the high levels of the Chinese corn futures.
Yep. Yeah. Look, they've been above $11, $12 for some time. Everybody's been focusing on the African swine fever situation, how quickly that pig numbers are recovering. That's starting to balk a bit. And it's quite important from the demand situation. We're talking about supply at the moment. That northern China area is what's really, really key.
I would just add in this other area. I have to make sure I reinterpret my maps right. I think that's wheat producing part of Russia.
Over on the left-hand side.
Right, over on the left-hand side.
Yeah, that's wheat producing and grain producing part of Russia.
The market really is saying, well, we've got moisture, everything looks great, but I don't know, it looks pretty dry to me.
Well, so there have been some rains over the weekend in a prices. But look, I think your next slide catches the, doesn't quite catch Europe yet.
Well, let's go to Europe. There
Let's
you
go to Europe, yeah. Because look, Russia's drive, that key area is the Ukraine. And look, that's the breadbasket of Europe. And that extends across Central Europe into Germany and parts of France, which are your major grain producing areas on that. So that's an increasing concern and adding a lot of pressure to move these prices higher.
So I know the markets are saying that it's out of sight, out of mind, but you look at how dry things are. It's just, and this is getting down into the soil profile. Europe, they talk a lot about northern France, southeastern England, etc. Do you want to talk at all about northern Africa?
Well, northern Africa is going to be key as far as, look, they're always importers, dry weather, not a large producer, but it's going to be dry, so their imports should be up. I actually am looking down at the South Africa area where that's dry, which you don't have circled, but South Africa generally exports, I think, about 17, 18 million metric tons.
In the balance of things.
And it's quite key, particularly for the sub-Sahara Africa area. South Africa supplies a lot of grain there. And if that continues to get dry and get tight, South Africa sort of fluctuates between export and import parity type situation quite regularly. So while Northern Africa is important, I think that Southern Africa situation is actually an area I'm focusing on a bit close.
So what do we anticipate for the U.S. this year? The USDA had come out at the end of March with a prospective plantings report. We've had high grain prices since then. So the high grain prices on the margin could shift some acres around. We don't have the South America situation fully in hand yet in terms of knowing how bad that is, but it's cut some tangible percent off their production. So high corn, soybean, sorghum, wheat prices across the board, it may end up and change some of these numbers USDA had put out earlier. There had been a projection, soybeans would be at 5%, corn up 0.4%. If there's any number I hear being discussed, it would be that the corn plantings would be higher given the high corn prices.
Yeah. Look, watching that corn soybean ratio here just over the last few weeks, it's seen a significant shift of that in corn's favor. And it's going to be interesting to see how the farmer reacts to that. In 2019, we saw quite a strong reaction, probably a shift more to corn than what a lot of people had anticipated. That was due to the wet season, but we saw a strong rally in corn and the farmer stayed on his corn planter.
As our colleague, Mark Wood, who will be coming on here in a minute, will attest to, we can do a whole lot if we have moisture, but if we're still constrained on moisture, it does limit their options a little bit. There is a report coming out on Wednesday, and I don't want to spend a lot of time on this, but there are a few key things to look at. Of course, we'll be looking at the old crop ending stocks, and note that the USDA in April projected U.S. corn stocks at 1.352 billion bushels for this old crop marketing year. And there's kind of been this idea in the trade that gosh, that number could come lower. So the average trade estimate 1.275, about 75 million less than that. So we'll be watching that. Lowest trade estimate down to 1.1. And so what's at issue here is feed use. We have a pretty good handle on everything else, but in terms of our reporting systems and whatever. So here's my issue, Guy. How long does the impact of a drought, of a short crop last? Well, it at least lasts long enough to take tight old crop ending stocks and make them into very, very tight new crop beginning stocks, yeah. Which means that instead of a 2 billion bushel carry in, you're going to start with something 1.3 or maybe 1.2, and you'll have to have just that much more of a great crop the next year to rebuild stocks.
Yeah, look, my bias is probably on the lower side of that estimate, and I really think we're going to have to dig into that wheat balance sheet to solve the corn situation. And it's just a matter of how much. I think you and I were both surprised that we hadn't seen the level of wheat feeding thus far. The prices were suggesting it, but the stocks report in March actually showed that probably wasn't happening. Probably my greater concern is the projected ending stock number for the next marketing year and how we're going to come in on that.
Yeah, that 0.120 is 120 million bushels of ending stock projected for soybeans, and where else can we go? If we shoot exports up much higher, then then we'll have to dig into crush.
Yes.
And there just is not that much of a margin. So let's go on. There's a sheet here on the wheat expectations. We'll be watching that too. Not a lot of fireworks there, other than maybe market expectation that the winter wheat numbers will go a little higher. For international audiences, Guy, you'd mentioned this earlier, we're watching the Brazilian corn number. The USDA's last projection was 109 million metric tons. So what's part of the fireworks in the corn market? We're whittling down that corn and ending stocks number out of Brazil.
And I think the key thing to keep in mind is we just previously talked about the ending stocks. We're such in a precarious situation. It's just small movements in the supply or the demand numbers has a fairly significant impact on the price.
Very inelastic, or to be economically correct, a very inflexible situation. Flexibility is when price changes as a result of quantity. So, we also have, this would be the world ending stocks numbers. Generally, they're slow reactors. I don't see them leading the way, particularly from USDA sources. But you do see from the April numbers that there's a projection that the corn ending stocks for old crop will be somewhat lower, not just slightly lower for beans, et cetera. And one thing that'll be good in this Wednesday report is that we'll have the first USDA WASDE report projection for the new crop 2020-21-22. And there won't be any surveys out on that yet in terms of in the field surveys. That really doesn't come till August, September for the full in the field numbers. So we're going to have X number of months before we have any in the field measurements of what the size of that crop is.
Well, the big elephant in the room on the corn ending stocks specifically is what are the ending stocks in China? And I think the trade completely acknowledges that it's significantly overstated. I think, if I recall, it's about 186 million metric tons.
Yeah.
And I think most traders that are engaged in that market would suggest they're obviously less than half of that, which is a significant change to that number.
I want to jump back. What I hear in the market is that the market isn't trading like there's 1.35 billion bushels of ending stocks in corn. It's trading like it's about 1 billion or below. So but implicitly we have a lot of fears. I wanted also to market, you want to get ready to come on in here. I want to show corn, soybean, and wheat prices. And note we have the spot cash prices. This was on Friday's close, but you have the new crop forward contract numbers. And you see across the board there, particularly the strength in Southwest Kansas, you see a 667 per bushel for a new crop bid. For corn, 696 for grain sorghum, kind of sticking with Garden City, 1349, almost 1350 in Garden City for soybeans, and 719. Note that the spot cash price in Garden City, where the feedlots are, for wheat, 719 per bushel, is less than the corn price of 792. So when we talk about our expectations of wheat feeding, it stems from that type of price differential with wheat prices being less than otherwise. So anyway, that's kind of where we're at. Mark, do you want to go forth then?
Sure, Dan. These matrices that are in the materials that were sent out to you ahead of time, they are based, with the exception of one, most of them are based on the recently completed Kansas Farm Management analysis. We just did that a week ago, and these are our enterprises, and each matrix functions the same. So I want to spend a little bit more time getting the layout for everybody to follow. I used as a base price here, Cornerstone Ag. It was $6.19 when I looked it up. The left half of the matrix represents variable costs, and the top line, or the column headings, if you will, that $594 an acre is variable cost of production for the average irrigated corn enterprise in the Northwest Farm Management Association. The right half of the matrix is total cost. So That includes a labor charge and a land charge, depreciation, real estate taxes, an interest charge. If you're using your own money, that's about $755. Now, the columns on either side of those highlighted, the ones with the line around them, represent a 10% increase going to the right, 10% reduction going to the left. So in total cost, the average might be $755, but you might be setting on your farm is $800 or even $900. Now, I would argue for most of our discussion purposes, we are at least one column to the right of the average already. Just with fertilizer and fuel price changes and chemical sum, we're looking at some increased costs coming with the 21 production. And that's not unusual. When prices for the commodities go up, the inputs go up with them. So that helps us get to a break even. So the horizontal line at 179 yield, that was our average irrigated corn yield in 2020. That's off the pace. We had some heat, we had some hail, we've had some challenges in Northwest. This represents our region's numbers. So if you can, and so the yield drops 10% going vertical from the average, it increases 10%. So we used to say, well, we got to have 200 bushel irrigated corn. And there are people that can produce 250. Southwest has got enough water in some places to break the 250. Well, the green area of this chart identifies areas where the cost, variable and fixed, are below that 619. Therefore, green means go. We can be profitable. If you're at 179 bushel average yield and your total cost were 755, you needed 422 to break even. I think 619 looks pretty good. Even the high cost people can have some poor water, if you will, 160 bushel yield, and they could make money at these prices. So high yields, lower costs, works great with these prices. The red area in here means you're not getting it done. These prices aren't high enough to cover your cost per unit. So that's a good general discussion. Irrigated corn looks great. Guy asked me about double crop soybeans in North Central, but the question I would have is this profitability is going to lead us to plant corn? Beans look good irrigated. I don't have a slide for that. But now we go to dryland production in Northwest Kansas. Same premise, no-till dryland corn, 268 variable cost, 345 per acre total cost. Average yield was 70. Our 5-year average yield's over 100 bushel. So we got burned with dry weather. And the weather patterns, you could see it in those maps I showed earlier, that we're still struggling. We don't have great submoisture. The other parts of the state look much better. But at 70 bushel yield, we can cover our total cost. If we move over to the 380 column, just because fertilizer is higher, we need at least 602. So we're not, these current prices, if you stumble and it stays dry and your yield drops into the 49 bushel range, you're in the red on total cost. It's all about production in this part of the world. And truth be known, it is all around the world. Dan, you can pop ahead. Let's look at the Milo, or the grain sorghum. I at least titled it correctly. I still say it wrong. Costs aren't quite as high, and yields were better. We had 80 bushel average yields across the association. Our association geographically, the east edge is Highway 183, Phillipsburg to Hayes. They had much better yields than we did to the west. The west was more like 60 and the east was 100. But even at this case with these, and this Milo price of 672 is a real strong, you can have that 50 bushel yield and make it work. And so those prices are great. And that would be our shuffle, if you will, between, is it corn or is it Milo? Which one are we going to plant? We've got the wheat stubble sprayed. We're ready to go into a fall crop. That's probably the only decision I see my producers making. And it takes less money to produce grain sorghum on average. It's going to be a toss-up. We tend to plant corn. The one thing that would lead us to grain sorghum would be it's dry. We might wait, give it a chance to get a rain, get a little better moisture conditions to plant in. That's a possibility. But grain sorghum is still a second place feed grain crop in Northwest Kansas to corn, at least the West, the extreme West. Flip ahead, Dan. I think we've got non-irrigated soybeans. In this particular case, we don't have a lot of them in Northwest Kansas. The North Central Farm Management Association has completed their enterprise analysis, and so I use their data. Good representative, good solid bean producing area of Kansas. Their cost $238 variable, $354 total cost. And my goodness, you could get down to 20 bushel yields and $425 an acre and still make that work. So, when you're thinking what's your yield potential, I think beans look really strong for north central Kansas. When we get to wheat, you'll see why the bean acres have expanded. And Guy asked me about double cropping. If the numbers look near almost as good in the dry land in the double cropping soybeans, I think they're going to plant what they can. So flip ahead, Dan. I did have irrigated soybeans. It's the only one in here, and this is from Northwest. I forgot we put it in. It's the only one that's green everywhere. So if I'm in a road, go ahead, Dan.
Unbelievably low total economic costs. Just amazing.
It's not too
you have to
bad.
grow them. It's a harsh environment for beans.
Our problem is we've been doing 50, 55 bushel yields. That means some are getting 65 and one or two get hailed and they make 25. The biggest problem for us is hail. Second biggest problem for us is the pH of our soils. They're getting a little high as you go west of Colby. Further west you go, the higher the pH, the more the beans struggle. But they tend to stay on a rotation. And here's the backdoor issue with soybeans, irrigated soybeans, is if you got a 3/4, 1/4 lease arrangement with your landlord, and the landlord doesn't pay any inputs, the corn is going to pay the landlord more than the beans from a gross revenue standpoint. And so there's some pressure from landlords to see their tenants plant corn because it generates more income for the landlord. That's just the way it works. Flip ahead, Dan. And then we've got our non-irrigated wheat. There's two tables. It might be a little tight to see, but the top half of the top matrix is just our dryland wheat. And then the bottom is specifically no-till. In 2020, the yield for the dryland was 42, and that may have had some eastern county bias to it. The West is more no-till, had a yield of 35. Costs are much higher for the no-till, that's the chemical, and more capital investment. It just takes more iron to do the no-till. At 40 bushel for just a plain non-irrigated wheat, that price of $6.98 looks great. If our yields drop, and Dan, you and I were talking beforehand a little bit, well, what was the freeze damage and what's the dry weather going to do and when's the next freeze going to come? And we're a long ways from having the wheat in the bin. But if you are an average cost producer, you really only get into the mid-30s before you run into some total economic cost coverage issues. The no-till is the same. They're about 30-ish as well. So, we've got to turn a 30 bushel yield on wheat, and we frequently do, but it's not, there's more red on this chart than there is on the beans, for example, or the corn and the Milo. Hence the reason we have more acres of corn than we do wheat out here.
A lot of
I think-
incentive to have 50, 55 bushel wheat yields, for sure, because then you get your cost down below 450 and you have a pretty good chance to cover full cost.
If you could knock out 50 bushel wheat and do it consistently, 50, 60, which we had the potential. We had a year we averaged 95 a few years back. And if you get over 75, you know, the wheat looks really good, but we're not set up for a boomer this year. Not with the forecast maps and the current moisture conditions, but, you know, I've seen wheat look horrible and turn out excellent yields. So it's a funny crop. It hasn't used all its 9 lives for sure. So I think that's the last one of my tables, Dan, isn't it?
Yeah, well, hang around, Mark, because there'll be issues that come up here, no doubt.
Okay.
I want to hit some high points on each of the main commodities that we're talking about here. Oop, did we get knocked out here a second?
No, I think we're.
Dan, just minimize that. Just knock it down with the little minus sign.
Oh,
at the
okay.
top.
Knock that out.
Well, no, yeah, the minus sign there.
Yeah, this right here. There you go, right there. Okay.
There you go.
Yeah, I think that's it. Well, while we're getting to the back into our presentation, when you look at the corn markets, of course, and if you look at it from a short-term situation, there we go. I get back down. We've had an amazing run up in terms of grain prices, and it's fair asking the question: Have we been here before? Well, in the corn market, yes, we have been here before. There we go. And you can see for the weekly charts, we ran up on Friday's close. This is July futures, 732.25. And because we have a fair number of people with an international concern here, I put on the per metric ton numbers also. So 288, basically $288 per metric ton, US dollars per metric ton as a price. And you can see we have to go back in the short run, back to the run up of the dry conditions in 2012. But the point is, we're there. We're in that vicinity. From a monthly point of view, if you look back to the short time in 2008 when we ran up above $7.50, and again 2011 dry conditions, again 2012, we've been there, but not that often. So we're in vicinities that, and really maybe our question might be, we only have 2 data points having been here before. On one of them, we stayed there briefly and then fell off like a rock. The 2008 rally, 2011-12 timeframe, we had ongoing issues of sustainability that came into play. I'd lean towards us being in more of the 2011-12 variety because we're so tight, not just here, but we have problems overseas also.
Yeah, look, I'd agree with that, Dan, particularly looking forward in your forward balance sheets, supply demand relationships, given the tightness of next year's balance sheet already, and we're not even there yet. I think, this is going to be sustained for this coming marketing year as well as next, and possibly even into a third.
We're at least we're going to start with really tight stocks, and it'll make us super sensitive to any threat to South American crop or the U.S. crop going into late 2021 into 2022. I want to put this up here, and if there's anything that'd be controversial, it'd probably be this innocuous little chart. And you can see if you look at futures, the old crop futures, and how they translate into a seasonal price for this year, you can see it on this chart. And again, from September, we were 71.8% of the U.S. season average price, which by my numbers, as I've calculated with the futures and the cash prices I have in hand and projected basis forward, about 474 as a price. Now the USDA has projected that price at $4.30, but by the time I calculate and crank it out, I'm about 474. So I think that USDA's number would be low.
Yeah, the challenge you have with this modeling is the shift we've seen in the pricing structure on the forward curve is we're not in a carry market. We're in a very, very sharp inverse. And so
you see that a little bit in terms of the drop off there.
And when all that happens, all your trade basically runs to the nearby with very little trade in the deferred. The new crop month being a bit of the exception, but it's going to be interesting with that sharp inverse, not only in corn, but also in soybeans as old crop approaches new crop, how that convergence is going to happen.
If you look to new crop 2021, starting in September, this year going forward, and look where futures are at, and take current basis levels, project them on out there, then the USDA has projected a cautious, wary $4.20 for the next marketing year. But just crank the numbers, it says $5.83.
Yeah.
So that is a major difference. You can see on for international buyers, you can see the difference in terms of a metric ton price also. So I don't know quite what to think of other than let the data speak. The data says that, man, we have high futures out into the next marketing year, and if we maintain the same basis levels, we have about $1.60 higher price than we have.
Yeah, and I sort of say that analysis is probably more correct than the USDA.
Well, the USDA has a different job than we do. So, and now we've got corn planting numbers. This, in interest of time here, I just want to say that's very likely the USDA numbers could be raised. And actually, where I've heard discussion of that was up in the Dakotas, in substitution for what was intended for spring wheat. We'll see. So, and I show a scenario there where we raise it about 2.5%, as opposed to what the USDA had done. I do want to show the pace of corn exports. Again, we hear about this and the strength of it, and the pace of U.S. corn actual shipments is tangibly above anywhere we've seen.
Yep.
That's the issue, and really the question, Guy, falling back into your realm, where's it coming from? China is importing in this marketing year about 26%. Right? They've been a receiver of that, and normally China is a blip on the screen of where we're at.
Yeah, China's shift from, I think, being down in the teens up to number one in a significant sort of way is just a phenomenal. And I look, it's the African swine fever situation which sort of made that shift. But I keep thinking China is, with corn imports, is sort of where soybeans were 25 years ago. And I remain quite optimistic, basically on the drivers in the animal livestock complex, that we're going to continue to see good strength of import demand, not only out of China, but Southeast Asia as a whole in there as well. But China's really going to lead that drive.
That Asian swine fever issue, big issue, having big repercussions as we go forward.
Yeah, and it's just increased uncertainty here the last couple of weeks. The incidence of African swine fever occurrence and significant questioning of the hog numbers continues to drive that. But it's probably as much as a shift from the backyard feeding, which used to be as much as 45%,
to verboten now. They can't do it.
It's basically completely shifted that, and what we thought would be a 10-year process to just overnight, it's all commercial feed.
Ethanol's holding on there. I did want to show you, what COVID-19 did in 2019-20 marketing year, and what that freeze had done this year. And note that what part of the strength in the ethanol prices holding up, and thank heaven they are, so that ethanol plants can afford to pay for high priced corn, is that we're having enough demand for fuel that our stocks haven't grown back up. If the stocks start to climb again significantly for ethanol and the price starts to drop, then we look to eventually you're closing ethanol plants. Corn index stocks, just want to show you, we are in a situation where percent index stocks to use dropping off precipitously from 15.7, 15.5 highs down to below 10, and wondering where we're going to go next year. I did want to put this out. I try to put together scenarios. In so many words, I said that what the USDA projected at 420 is about maybe a 40% chance of being right, but a 60% chance of something else being right. I'm in essence, good chance that their acres are probably too low. Well, I got it. Yeah, there we go. That their acres will be higher, their yields will be lower, and we'll have to see where that works out at. But chances are that prices will be higher than what the USDA is projecting. I did want to just put this in here. Why are prices so explosive? because we're sitting kind of on the precipice. We've already seen high prices, and in terms of what USDA cash prices are showing, you get below 9%, you're getting to that inelastic part of this response curve, and then prices start to be explosive.
Yeah, just while you have the stocks to use ratio price up here, I sort of want to bring in a macro issue. Look, we're at the far left-hand side of the curve, so your model starts to become break down a bit. But you'll notice most of these stocks to use ratio models only go back to 2007 and 8, when we had a significant quantitative easing, and our models sort of broke down a bit because of the change in the value of our
structural change.
And I can't help but think, look, we had a 25% increase in the N2 money supply in 2020. We've had significant quantitative ease since then with significant government spending. And I just sort of scratch my head and worry that we're just on the edge of another shift on the structural change and the devaluation of the currency as we look at
the devaluation of the dollar in international markets tends to raise the price of U.S. grain.
Exactly. So that's what really keeps me, probably the underlying flavor that keeps me optimistic across all commodities.
Also, the other side of this, and Mark, for you to be thinking on, and I think you've already mentioned it, the devaluation of the dollar tends to also raise our costs. So we can have higher prices and be no better off if you have inflation.
Well, just last week, the Commitment to Traders report showed, if it wasn't a near record number of fund money and spec money that has come into the ag commodity market.
Yep. Mark, did you have a comment?
Well, I did. One of the struggles with fertilizer is we do import a fair, particularly the FOSS. And so devaluation, I've had that discussion with some of my producers where the currency can make their corn price better, but it ends up raising the cost of some of those inputs that are imported. So you guys are right. Inflation's
a great thing until you have to start paying for stuff. So let's move on. In the interest of time, I'm going to show this on the international side, then we'll move on to grain sorghum real quick. And I have some things there you can refer to. I'm always impressed by the ongoing growth, 3.7% total usage in total corn in the world. And production growing at a little slower pace. If anything, the last 4 years about leveling off. So why are we in this situation? Well, because usage has continued, production's plateauing a little bit, and you can see over on the right-hand side, about 4 years ago, we had 352 million metric tons. That's with China included. And you take that when we've been declining down. I do want to, there's some things there that that we could look at, but just in taking a look at Guy, I look at this chart and I wonder how it can be true. And let me tell you my conundrum. I see production pretty level. I see domestic use growing. I see a little bit of imports. If you, with that type of mathematics, how do we get stocks like this when the difference between those is that?
Yeah, well, that's a good question.
That's a good response economically.
So that's why I think for some time we've been significantly discounting that level of ending stocks that we see for China. And as I said earlier, I think it's easily less than 100. Some of the commercial trade would say it's even half again of that. The prices currently in China would suggest it's less than 50. What it is, we really don't know. But if I sort of do the exercise, what's China going to use? What do they need to produce? And basically do the equation with leave ending stocks unchanged. How do you solve the balance sheet?
We solve it on the margin. Grain sorghum. You look at a very similar chart to corn, following the futures. If futures were right, we'd see a fall off going forward into, and these would be the highs. We shall see. USDA projection of 505 per bushel for sorghum. Using a futures model, I look at this current old crop market, you're about 585. We'll see, I guess. For the new crop year, they're projecting 470 conservatively going forward. I plug in the futures for next year using current positive basis. I've got 710. So And again, I'm doing something different, have the luxury of cranking numbers and putting this out for the USDA. When they put out a number, it affects farm payments, a whole bunch of things. So they have to be super careful. That said, projections right now, if the futures are holding true out in there, then we're $2.50 low for next marketing year for grain sorghum.
Well, the big question grain sorghum is going to be that basis level, because we don't have an underlying grain sorghum futures and it's traded as a basis versus corn. That old crop, new crop basis differential is quite large. And given China doesn't change their policies, we could see the premiums this coming year that we saw this past year.
I'm going to show you. So here, grain sorghum exports have, for a while there, they were just so, but here of late, they've jumped up. So they're getting, by the time we get to the end of this marketing year, they could end up being on a historic high. But this is the deal. We have a very strong, but a very narrow demand base. 99% of all the grain sorghum shipments in this marketing year went to China.
Yep.
99%. So, wow.
And that puts us in a fairly precarious situation. And I always remind my colleagues and people in the industry that China is a command economy, centrally controlled, and all it takes is basically the stroke of a pen to change the taxes and the tariffs and change that relationship between corn and sorghum overnight. And but I'm increasingly optimistic, given the tightness of stuff in China, that this sort of premium is going to continue for at least next month.
If they weren't so in need, we'd be a lot more precarious with this. But they are so in need that this is very likely probably going to keep going. Exactly. Just want to show something. We talk about historic highs. You devalue the U.S. dollar, take world less China coarse grain stocks. And basically, grain sorghum prices are equal to the highs of 2012-13. Yep. Take a look at wheat. We've got about 10 minutes left, so I'll hit on some major things. We'll do wheat and soybeans. You look at this price chart for wheat. Friday's close, 736 for July, 736 and 3/4, 271 basically U.S. dollars per metric ton. And you look at that from a historic point of view, though. We had some glory days in hindsight. I don't know if we thought they were when we had them, but they sure were back in 2011, 12, and 11, heading into, and part of 2013, and especially 2008. And so we've got great wheat prices, but not more than we had before. Wheat affected somewhat, cross-affected by what's going on in the feed grain market, with a fair amount of wheat feeding going on around the globe.
Yeah, I think the wheat story is basically corn, and as we mentioned earlier, it's going to be a question of how much wheat goes into feeding to tighten up that carryover stock.
Here's a similar metric in terms of prices for wheat. Been pretty flat. Not even again in this marketing year, we've been basically flat for wheat prices, and USDA has projected $5 per bushel for this marketing year. You look at the futures number, about 507, so I'm about right with them. But we part ways again in terms of their wary, cautious projection for next year of 550. And I crunched the futures, use current basis levels, $7.30. It's a $1.80 differential. So eventually the futures and the cash have to come together. Yeah. But right now the futures out into these next marketing years are representing something way different than what USDA had said. So, and wheat exports for all wheat, strong pace. Hard red, we've been falling off, but white wheat and spring wheat have been carrying the bucket. So I see that we're falling off in terms of hard red, but I also live in Western Kansas and see what has to be wheat feeding. I say it has to be, what seems like it has to be, and I see that, and I think exports to some degree are getting crowded out by feeding. Yeah. So, and again, China now, strong player in the current purchases. Let's move on here to soybeans, the time we have. Again, the prices we've seen for soybeans are amazing. They're literally amazing. $15.89 3/4 as a close for July contract, $584 per metric ton. So, but when you look at on a per month basis, monthly basis going back to 2006 to when ethanol came in, affected all these markets. We've been here before, but not that often. We've been here twice, but with less frequency even than for corn, really, especially in that 12, 13 time frame. So we're at high levels. How much higher do they historically go? Well, they go as high as people desperate to gain supplies, to keep their plants running, to feed their populations will take.
Well, the interesting thing in driving this whole oilseed market is the strength we're seeing in vegetable oil. We've seen the meal come off, and that's really being underpinned by one, the tightness in the palm oil production situation coming out of Indonesia and Malaysia.
Thank you. Yep.
And that's really impacting that, and underlying that is the biofuels demand, the biodiesel demand that's really driving that. It'll be interesting because if you believe that we're going to be inflationary, crude oil prices I think have upside, and that's going to impact corn and soybean, particularly on the oilseed complex.
Crush and exports have been banging against each other.
Yep.
And who's going to give when there's not anything left of the bin?
Exactly.
So projected prices, again, you have the April numbers there, USDA projections for the old crop marketing year of 11.25. I show about the same, if anything, a little bit lower based on our futures numbers. But new crop year, they were conservative, 11.25. I've crunched the futures, used current basis levels. I've got $1.90 higher. So we'll have to see where this goes. And acreage, the USDA's projection 5.4%. We saw Mark's numbers on the cost of production for soybeans. Really, the thing that constrains soybeans is crop rotations, that you can't grow them every year. So you see what higher rotations do. There's the exports. Just what you can see where the South American crop came in when our curve started to bend.
Yes.
And China, 62% of all U.S. soybeans. I think over time, they still are pretty strong, about 36%. You look at 3 previous marketing years, but now they're in strong. I just wanted to show this in terms of domestic crush, exports, ending stocks. So mainly to support my point, Guy, that if it's either domestic crush or exports, if they jump up higher, there's no place to go. There's no place to go, really. So in terms of projected prices for the coming year, that's a conservative number here. I've made those and I looked at the futures, and I'm just as conservative as anybody else, I guess. But what the futures are saying is something way higher than what our USDA is saying, and even what I'd done based off the USDA calculations. I do want to say that if we look at the U.S. soybean price versus U.S. stocks to use, and normally you'd see at these stocks to use numbers, we would be, well, basically we'd be where the futures are saying we're at.
Yeah, I guess the thing that's a bit misleading on this average USDA number, it's over a year time period.
They had the first 5 months were heavily weighted and they were short.
And so we're on the front end of that, which is going to lag behind.
That explains 2021, but doesn't explain 21, 22.
That's correct. Or when we get to the back end of those situations, then it tends to curve the other way.
And soybeans, again, we got about 5 minutes left here. Soybean usage strong, 5.5% per year, but based on some early period growth, about just under 6% per year growth in production. But the last couple years, we've fallen off. And there we go. And just kind of finish up here, you can see Brazil, what's going on for their trends in soybeans. Look at the exports in the blue, production in the green. They grow to export, basically. But Argentina used to be right in there with that, but they're growing, their growth and their domestic, their production is almost all taken up by their domestic crush.
Yeah, and that's just due to the export tax situation.
Yeah, that's it.
Really encourages crushing the processing.
And here's the China deal. The growth in the blue in imports, there's their total use projection continuing to grow. They do have some production, but again, so I see. So I guess I wonder how they have that 32. When you start looking at the amount of production they have tied in with the total use and such, and so those are the numbers that make you wonder about the Chinese.
Yeah, well,
numbers.
look, I'd say the soybean stocks number is probably a lot closer being correct than the corn or even the wheat, because it has been
an import
net importer for 15 years now or better. So they've got those stocks, and they have regular weekly reporting, and I'd say they're not too far off. One thing I'd say, the growth in the stocks is probably a symptom of maybe that recovery in the pig numbers isn't quite as great as what we anticipate.
The disease issues are reemerging a little bit, we hear. Okay, last slide here. Did want to U.S. soybean price versus world less China. And again, we're at a point in the more recent times as we've been higher, when we've been in 2011, 12, 13, we're at $13, $14. Our current numbers are 11, 20. I think what you had stated before about the front loading with lower prices affected this, but for next year, you would wonder where that's going to go.
Yeah, that's exactly.
Well, we hope to get done with 10 minutes left for discussion. And Rich, we've got done with 3 minutes left for discussion. So we at least we've got something. Are there any questions that we can try to address?
We haven't had any yet, folks. Go ahead and put the questions in the chat, and let Dan and Guy and Mark respond to you.
I have a question for you, Dan. If you've got carry if you've got a pretty good futures price expectation for next year's wheat, should a wheat producer be thinking about watching for opportunities, given our cost of production? Even if you add another 10, 20% to the cost, should they be considering pricing further than just this crop?
Mark, you and I have looked at the risk profile there, and if we were only looking at price risk, we would say absolutely. But it's the production risk that hedgers face, forward contractors face out there in the West, with hailstorms and you name it, that come into play. If someone does that, they're probably judicious on the percent of their expected production that they're doing it at, given that far out in terms of what can happen. So should they, from a price risk management point of view? Yes, probably. But it's the production risk for a hedger that comes into play. Now, for an end user, absolutely to hedge, because, well, I say absolutely, but a 50% risk of prices being even higher, you'd want to protect yourself on a deal like this.
Just 2 comments on that, Mark, from where I'm sitting is, I'd probably suggest if you're going to manage your risk with derivatives, I'd probably look more at corn, and that's given the corn wheat relationship. And if it's in a derivative, you can always change that back to wheat later in the future. So you're still managing the price risk. My bigger concern would be the point you mentioned earlier, is I'm just really scared of a significant inflationary situation we're going into. Whereas if you're managing your price of your output, are you managing the cost of your inputs? And just already, as you mentioned, the increase we've seen in fuel and fertilizer, look, that's good, and even machinery costs are going up significantly. Are we managing the cost side of that?
If there was a financial tool we could hedge to protect against inflation, that might be another discussion for another day. And then there probably would be to try to.
Well, the fun guys are all running to ag commodities to own them.
So they're using us. They're using us. Oh, okay.
To be shorting what the fun guys are selling.
That makes sense, I guess.
I would say that one thing that has seemed to me that has changed in the last 30 years is that in the older days, when prices began to come up, inputs tended to lag their climb by much longer than they do now. The minute our prices start up, the inputs are moving with them, and it's like, good grief, I haven't even produced a crop and you're already after me.
Yeah.
So there's a sense of that going on too.
Exactly.
Well, Dan, I haven't had anything else here. A couple of folks have said thank you.
Good.
And folks, if you do have a question, now's the time.
This presentation is on Ag Manager, I think, Rich. And
yes, and the recording of the webinar will also be posted either later today or tomorrow morning.
And in the presentation, we have a number of slides for our international audience with prices and other quantities in metric tons. So that's meant to help our international group that would wonder about prices per bushel. So we've got the metric ton numbers in there.
Okay, well, I think that's about it. We're not getting any other questions. So thank you very much, folks. And Dan, Guy, and Mark, thank you.
Thank you. Thanks.
All right. We'll see you.